Morning, everybody. Good afternoon. Good afternoon, everybody. You'll probably see this video in the night because I'm just doing this video now. But today we'll be talking about demand and supply. Demand and supply. From what we can remember in our economics, in demand and supply, we learned that demand is where price is being bought from, and supply is where price is being no demand is the price, sorry. Demand is the price where a specific commodity is being bought at. So you can jot this down anyway. If you have a very strong memory, you can remember it. Demand is the price where a specific commodity is being bought at, and supply is is, where supply is where a commodity supply is the price where a commodity is being sold at. So that means the moment we get to a price that where demand is, that means that price will buy from there. Let's say call this a demand, price will buy from there. And when we get to a point of supply, price will sell from there simply. Price will sell from there simply. So having the information that demand is where price is being a commodity is being bought from, the price at which a commodity is being bought from, and supply is the price at which a commodity is being sold at, we can then say that we can call a demand. We can also call a demand a support, and we can also call a supply a resistance. Because since demand is where price is being bought at, that means the price the price of a certain commodity is being supported by that region of price. So the region of price can be from $83 like on silver to 82.92, whatever it is. A support would then be the area that a demand is at, while a supply will be a resistance point where price fails to break through, where price sells from, where price buys from is a support. So in trading, we use more terms like resistance and support instead of demand and supply, because we deal with more of areas than of a specific price point. We deal with more of areas than a specific price point. So we cannot just say that price is surely going to come to $83 an ounce for silver and buy from there. All we can say is that in this area, by a series of confluences, we can say that price is going to buy from $33 and it could still come back to 82.8. We're still happy to enter a trade at 82.8. So that is why the instrument we use to detect supports and resistances on a chart is called the rectangle object on TradingView. So as I've earlier stated in another video, we added this to our favorites. So now, on the topic of support and demand, let me draw a simple chart and then we state where we have support and where we have resistances. It's a very easy subject, very simple course. So let's give two scenarios: price moving in an uptrend and price moving in a downtrend. Where will we put our support and where will we put our resistances? If you can notice, so now what we do, we will change this to support and resistance. And change this to support and resistance. So as earlier stated, the support is where is where the price of a certain commodity is being bought from, the area in which a commodity is being bought from, and a resistance is where a specific commodity, the price at which a specific commodity is being sold from. So we can then say that a support holds price for the buyers and a resistance holds price for the sellers. So now there are something called swing points. These are points in prices. These are points or prices that a certain commodity holds or supports. So they are the prices that a specific commodity supports or resists. You understand me? So where would we call those swing points in this scenario? We will call this swing point, we will call this support 1. We will call this resistance 1. Call this S2. We call this R2. We call this S3 and we call this R3. So we can then state that a resistance can be turned into a support. Simply, a resistance can be turned into a support by the use of swing points. So it is where price got to, retraced, and then blasted through or blasted down. Same in this situation. This is called R1. This is called S1. This is called R2. This is called S2. R3. S3. And this can be proven in any single market that you find, as long as it's going in a clear direction in an uptrend or in a downtrend. Even if it's in consolidation, which I will explain later, it still follows the simple laws of demand and supply, support and resistance. So given this chart that we see, we can say that a very strong area is this area. Why? Because it was resisted here, it broke through, then it came back to support. So we can say that this price this price range or this support area is the area of price that buyers and sellers are located at. So swing points are places that buyers and sellers are located at. We can also call this a very strong one, and it's more central because we can see sellers here and we can see buyers here. We can see sellers here, buyers here. Price resisted, it came back to S2 and pushed higher, came back down and retested this support area. You can also call it, so the moment that price breaks through a former resistance, it's called a support. And the moment that price breaks through a former support, it's called a resistance. Very simply. And now to call a place, a specific point in price, a strong level of resistance or support, it needs to have at least three touch points. So with the understanding of this, we can say that we have a market now, a normal market moving in downtrends and uptrends. So we have this kind of market. So this market was first moving in a downtrend, went in an uptrend, continuing in a downtrend, went in an uptrend, now a downtrend. So this is a multi-directional chart that we see here. Okay, so now let's note places of resistance or support or the both. So same thing that we have been doing, we can call this. So let me just, instead of using lines, let me just put it there. So we can call this R1, S1, R2, S2. Then we can call this, here we could call this S2, S3, because it's supported price. Another swing point. We can call this, so since this is S3, we would call this R3, we call this S4, R4, S5, R5, then we'll call this R6, then we'll have S6, R, R7, R, this would be S7, R8, this would be S8, then this would be S9. I hope you can understand. I hope you can understand. Then from S9 we go to R9. Here we get R9 Ronaldo. Then we get here and we say R10. This is S10, R11, S11, then S12. So we have noted different points in price that price has gotten to. So if we simply draw an area that price has supported and we just draw that across, and we draw from here to here, draw it across, draw it across. Yeah, and we call this the next one. So we can state that this area here, let's call this A1, A2, and A3. This is a very beautiful chart because we see that area 1 has been held how many times? 1, came back here, 1, S1, R2, 1, 2, 3, 4, 5, 6. So this has 6 touch points. So it is a very solid area of resistance or support. So if price ever comes back to this area, we know that if price gives us a signification that it is selling from this area, we sell. But if price breaks through it and retest it, we buy. So this is why we use support and resistance, because we just want to buy at the proper areas and zones that the market is being bought or sold at. So this shows, so that chart shows the differentiation, how a support can quickly turn into a resistance and how a resistance can quickly turn into a support. Now we get here, we go to A2 and we see that price came here 1, 2, 3, 4, 5, 6, because it came down here, 7, 8, this price came down here, 9, 9. So 9 times. So this is a more stronger area than this A1. So we can call this the primary area. So whenever we get to this point in price, we want to either buy or sell given the conditions that the market gives us. So if peradventure this market goes like this, it breaks this, comes down to retest, gives us a bullish engulfing that we length. Probably it gives us here a bullish engulfing that we length. We take a trade here, put a stop loss here, and target these highs. This should be about a 1 to 2 trade. Very simple, very sharp. Quick money. But what I'm just trying to explain is that a support can turn into a resistance at any point, and a resistance can turn into a support at any point. And now A3 can be called a proper support area. Buyers are demanding price from this area. So peradventure price comes back to this area, we only have one thing in mind, which is to buy. But if price breaks it and retests it, then we look for a sell, according to what the direction of the market from the higher time frame is giving us. So this is simply the use of support and resistance in the charts. Simply the use of support and resistance on the chart. So this is what we look for to place a trade. But also, a support and resistance might not need 3 touch points. What are the criteria for it not to need 3 touch points? Criteria 1, it must be at an all-time high. So commodities like gold, silver, the S&P 500, they are all hitting all-time highs every single month. Every single month you hear all-time high, all-time high, all-time high, all-time high. So when you see that price is moving at a faster pace, we do not want to disregard this area of support and resistance. So if price ever comes back here, we'll take a trade from here. Very simply. So on fast markets, very super quick markets, we do not need 3 touch points. At least we need 2 touch points, a resistance and a support. So we need 2 touch points on fast markets. Second confirmation is if it's at a psychological level. A psychological level is any point in price that contains a lot of zeros. So we have 4,600, 4,000.000. We have 4,700.000. We have 4,800.000. 7,000. You understand these kinds of points. So the moment you see that price comes into these kinds of areas, they are a strong level of support or resistance, because buyers will want to take their profits and sellers will want to take their profit too, if it was a support or if it was a resistance, based on the based on what the chart is giving you. So if the chart is moving in a downtrend and you come down to a 6,000 level, you know you are going to buy from there. And if price breaks it, you look for a retest and sell. But if price is moving in a clear uptrend, the moment you get here, this place is 7,000, you sell. Very, very, very simple. Very, 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 very simple. So these are the only 2 criteria that you only need 2 touch points to place your trade. Only criteria. The more stronger criteria is the psychological level. So you will only place a trade according to the FSH strategy. It states that you will only place a trade when you see that price has gotten to a psychological level and the market is moving super fast / all-time highs. So you must have these 2 confluences before you can place a 2 touch points buy or sell at an area of resistance or support. Simply, these are the only 2 criteria that you need to place a 2 touch points trade. So this is the end of this class. Very sweet topic. Very easy to understand topic. So what we have learned from this is demand is the price at which a specific commodity is being bought at, and support and a supply is the price at which a specific commodity is being sold at. So an area of demand can also be called a support, and an area of resistance, an area of supply can also be called a resistance. So resistance are areas of supply, and support are areas of demand. Very simply. And a demand can be turned into a supply. A resistance can also be turned into a support based on the criteria that is shown. But to place a trade, we must have at least three touch points. We must have at least three touch points. We must have at least three touch points. So here we have one, two, three, four. So if price ever comes back here and does not break it and gives us a bullish, bearish engulfing, we take a sell. But if price breaks through it, retest it, we are looking for a buy if we get a confirmation. Very, very simple. So it will be shown on the chart, but we would apply all these theories that we are making up on a chart. So that's just it for today. Support and resistance, demand and supply.